Good afternoon, everyone. Welcome to Bulls, Bears, and the Bell. This is your afternoon wrap-up.
And it was quite a wrap-up today.
It certainly was. Tuesday, November 18th, 2025 really felt like a decisive trend-down day. We saw some aggressive risk-off degrossing out there.
That's the perfect term for it.
And it marks the fourth straight decline for the S&P 500, all fueled by just extreme caution ahead of some major events on the calendar.
Yeah, the story of the day was really a failure to hold any ground. The prior day's close, it immediately became resistance.
A ceiling.
A hard ceiling. And from there, you saw confirmed technical breakdowns across the major indices and, a huge change in sentiment.
Right, you could feel it, and that was driven by that sharp spike in the VIX.
Exactly. The fear gauge confirmed we are absolutely in a risk management regime right now, not a risk-seeking one.
So let's get into the damage report.
Yeah.
The S&P 500, the SPX, it dropped about, 0.95%?
Around there, yeah. And it closed at 6,608.68, which is a new multi-week low for the index.
The Dow Jones Industrial Average was down 0.77%. But the one I'm really watching is the Russell 2000.
The small caps.
They lagged the most, down about 1.1%. That seems to confirm that weakness in small caps and suggests a pretty broad capitulation.
It really is the canary in the coal mine. That Russell number tells you the pain is widespread and the smaller, more rate-sensitive companies are feeling the squeeze.
And the Nasdaq, the IXIC.
It was actually the best of the bunch, relatively speaking, only down about 0.58%.
Still, you mentioned technical damage. What was the red line that the market just sliced through today?
The absolute most important short-term support level was yesterday's intraday low, specifically 6,638.90 on the SPX.
Okay.
Once the market broke that level, and it did so pretty decisively, it confirmed what technical traders call a lower low structure.
Which is a clear signal the uptrend is broken.
It's a definitive signal, and maybe just as important, we finished the session right near the intraday lows.
Right. No late day heroes.
No conviction from buyers at all. It just tells you there was nobody willing to step up and defend the floor into the close.
Okay, let's unpack this. So the index moves tell us where we landed. But how did the internal gears of the market confirm this selling pressure? Was this, a slow bleed, or was it real panic?
Oh, it was intense panic. And the internals confirm it with blinding clarity.
Where do we start?
Let's start with volatility. We already touched on it, but the VIX surged nearly 13%. It just kept accelerating all day and closed at 22.38.
When you see a move like that, what does it signal?
It signals institutional desks are scrambling for downside protection. It's not just managing risk in one or two names. They are hedging their entire portfolio.
So if institutions are hedging, how did that show up in the actual, the moment-to-moment trading?
That's where you look at the high-frequency metrics. Take the NYSE tick.
A measure of stocks trading on an uptick versus a downtick.
Exactly. And today, the tick closed at an extreme negative of minus 950.
Minus 950. For listeners who might not track this daily, what does a number like that really mean?
Think of it as an emotional barometer. Anything below, say, minus 500 signals high fear. So minus 950 means that right into the bell, selling orders just massively outnumbered buying orders. It's pure fear-driven distribution.
And this wasn't just the big names getting sold off.
Not at all. The NYSE advanced decline line was deeply in the red. We're talking minus 1,800 net decliners.
Wow.
Yeah, that's an overwhelming breath failure. It confirms this was a liquidation event spread across the vast majority of stocks.
Okay, so we have broad selling, extreme fear, huge imbalances. What about the quality? Was there real volume behind this move?
That's where the trend comes in. And yes, the quality was high, which means the move has real conviction behind it. The trend closed at 1.55.
And trend, just briefly, compares advancing and declining stocks to their volume.
Right. A number over 1 means volume is heavier in the declining stocks. So a 1.55 reading tells you that the volume on declining stocks was 55% greater than on advancing stocks.
So the sellers showed up with serious size.
They did. This wasn't a light volume drift down. It was a high-quality, volume-driven decline.
So every internal metric, breadth, volume, execution, it all screamed bearish. But you flag one fascinating countersignal.
Yes, and this is where the nuance comes in. If everyone is terrified all at once, the market becomes vulnerable to a snapback.
Okay.
Our only contraindicator warning today is the total put-call ratio. It hit a really elevated level of 1.20.
Which means traders bought 20% more protective puts than speculative calls.
Correct. And that level puts us squarely in the extreme pessimism zone. Anything over 1.10 usually is.
So while it confirms the fear,
Exactly. While it confirms that fear, historically, when sentiment gets this stretched, when basically everyone who wants to sell or hedge has already done it, it raises the probability of a short-term relief bounce.
just because you run out of sellers.
You literally run out of sellers. It's just technical exhaustion.
That's a vital piece of context. So the trend has turned bearish, but we might be momentarily oversold.
It opens the door for some serious volatility in the other direction, even if it's brief.
Now, breaking down the sectors, we saw a classic flight to safety event, which makes perfect sense given the degrossing you described.
It was a textbook rotation. Information technology was the clear laggard, down 1.43%. It accounted for most of the S&P's drop.
Which feels like a direct hedge against that AI hype trade.
I think so, especially ahead of some critical earnings reports. People are just de-risking those long-duration growth assets.
And it wasn't just tech.
No. The cyclicals, anything tied to economic growth, they were all abandoned. Materials, financials, energy, all major laggards. It's a clear pause in the whole reflation trade.
So where did that capital go?
Straight into the defensive anchors.
Yeah.
Utilities, consumer staples, and healthcare. They all held up incredibly well, barely declining, or in some cases even closing slightly green.
Here's where it gets really interesting, though. Let's look at the factor clash. The difference between risk and safety today was just staggering.
Staggering is the word. I mean, this is the most objective, quantitative proof you can find that risk appetite has collapsed.
So you're looking at the high beta index versus the low volatility index.
Exactly. The S&P 500 high beta index, that's your most aggressive, momentum-driven stocks, it plummeted 2.16%.
Okay.
Now, contrast that with the S&P 500 low volatility index. It only declined 0.18%.
That's a 200 basis point difference in one day. What does a spread that wide tell you?
It tells you the market is completely rejecting the growth playbook of 2025. Low volatility outperformed high beta by a massive 2%. That's maximum damage to momentum factors. It confirms the game has shifted to recession resilience and a fear of multiple contraction.
Quality and defense are paramount. Got it. Okay, let's look at the winners and losers after the bell closed, because we saw some extreme moves.
The after-hours session was wild. The biggest mover by far was in biotech. Olema Pharmaceuticals, ticker OLMA,
Which shot up how much?
approximately 148.9%.
Wow. What on earth happened there?
It was a classic read-across trade with a dual catalyst. First, a rival drug maker, Roche, announced positive breast cancer trial results.
And traders immediately re-rated OLMA's potential.
Instantly. And that fire was then fueled by a major analyst upgrade from H.C. Wainwright, raising their price target significantly.
I have to imagine there's huge risk in a move like that.
Extreme liquidity risk. It's a low-float stock moving violently. Not for the faint of heart.
So outside of that biotech frenzy, we saw some interesting institutional accumulation, right? Specifically in financial services and industrials.
Absolutely. While the masses were selling, we saw some notable gainers that suggest some smart money was bargain hunting. Ingersoll Rand, Broadridge Financial, and Northern Trust all moved up post-close.
And Ingersoll Rand specifically jumped 10%. What was behind that?
That was driven by a disclosed purchase from a major pension fund, the Commonwealth of Pennsylvania Public School Employees Retirement System.
So when a big long-term player like that makes a public move,
It signals real structural conviction. It suggests that even with all this macro fear, some of these specific sectors might just be due for a valuation re-rating.
okay, so let's pivot to the forecast. What does all this de-risking today mean for tomorrow? It's a huge day for data.
Tomorrow, November 19th, is absolutely stacked. We start with the macro drivers. At 10:00 a.m. Eastern, we get the JOLTS job openings for October.
A key input for the Fed, it's expected to cool a bit to 7.15 million.
Right, but the level you need to watch is 7.10 million if the print comes in below that.
What's the implication?
It would signal the labor market is loosening faster than anyone thought. That could fuel a huge rally in growth stocks and push bond yields lower. It would scream, Fed pivot.
And then at 2:00 p.m., we get the FOMC minutes.
Exactly. The market is going to be dissecting the language around two things: the terminal rate and the pace of quantitative tightening, or QT.
So any hint of higher for longer could really pressure stocks again.
It would instantly put pressure back on yields and rate-sensitive stocks, yeah. It would just refuel today's bearish trend.
Then we have the micro catalysts. The earnings reports are high stakes. Pre-market, we get TJX companies.
For TJX, it's all about same-store sales, the comps. They cater to the middle-class consumer, so their numbers are a crucial tell on consumer health heading into the holidays.
And after the close, the big ones. Palo Alto Networks, and of course, NVIDIA.
For Palo Alto, you're watching RPO remaining performance obligation and billings growth. If those miss, it signals a slowdown in cybersecurity demand.
And finally, NVIDIA. This feels like the single most important event of the entire quarter.
It has an extreme risk profile, not just for itself, but for the whole market. The bar is set so high.
What are the two things traders must focus on?
First, data center revenue and the gross margin trajectory. And second, the Q4 and full-year guidance. A beat is already priced in. The entire reaction will hinge on whether they raise the forward narrative.
If they don't.
If they fail to dramatically raise guidance, it will almost certainly be treated as a sell the news event.
So given the intense degrossing we saw today, it sounds like the market is positioned for disappointment from NVIDIA.
They've absolutely priced in a high probability of it, and that creates this environment that is so susceptible to a whipsaw rally if the news is even just slightly better than feared.
Which brings us to the technical line in the sand for tomorrow. The 50-day moving average on the S&P 500 futures, which is right around that 6,700 level.
That's the key level. A decisive close tomorrow below 6,700 would trigger a wave of stop-loss selling and confirm a much deeper correction is underway.
So to wrap it up, we have a deeply bearish trend, but at the same time, the market is technically exhausted and oversold based on that extreme put-call ratio.
That's the paradox we're facing. While the intermediate trend is clearly bearish, you have to watch for a sharp snapback rally at the open tomorrow.
And what's the key takeaway for our listeners on how to trade that?
The key is to view that potential bounce not as a signal to get long, but as a tactical opportunity to reestablish short positions at better levels.
A snapback to reload shorts. A truly provocative thought for a high-stakes day.
Stay sharp out there.
And that's the bell. Thanks for listening to Bulls, Bears, and the Bell. Follow us to stay one step ahead of the market.